Welcome back. Thank you so much for staying tuned in. Well, time now to turn the page to this week's edition of Women's Wednesday. And on this week's edition, then, let's take a closer look at the power of financial independence. In fact, my colleague Kavita Thapliyal is in conversation with Kruti Chheda, who's the fund manager and fixed income analyst at Mirai Asset Investment Managers India, who shares the to-do list then for investment for women. Let's go across and listen into a slice of that conversation.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back. You're watching this very special Women's Wednesday edition today. And since we are talking about fixed income instrument, let's just dissect and go in depth on short duration funds. To explain this, I have with me Kruti Chheda, fund manager and fixed income analyst from Asset AMC. Hi, and welcome to this new edition of Women's Wednesday. And we are trying to simplify fixed income instruments for women. You know, in your last episode, you explained as to what's the difference between a fixed deposit and fixed income instruments that mutual funds have to offer. But then within this category, let's talk more on short duration funds. So what's the time frame? Because it's called short duration fund, it will be for a shorter period of time, right?
Right. So a short duration fund is something that can vary from 1 year to 3 years.
Okay.
Both the categories are there.
Okay.
So up to 1 year category is where most of the money market instruments are involved. When we say money market,
What is money market instruments?
When we say money market instruments, those are the instruments which have maturity up to 1 year.
Okay.
So that
for example,
that can be issued by banks.
Okay.
That can be issued by corporates, or that can be issued by government. But the maturity has to be 1 year.
Okay.
Okay, so that is up to 1 year category. When we talk about 1 to 3 year category, we are talking of a more broader perspective over here. So that can include your up to 1 year instrument, as well as it can include corporate bonds. So these are the longer tenure bonds which are issued by the companies, and an individual as an AMC we invest in these corporate bonds. But the maximum maturity, because it is a 3 year product, we can invest only up to 3 year or maybe like a 5 year, but eventually we have to manage the duration up to 3 years. So we can do excess of a little 3 year product, but then we have to compensate by doing the lower maturity in other like a money market product.
Okay.
And then to add to the market movement or take the benefit of the market movement. So essentially when we talk about these products, your corporate bonds are mainly there to give you the higher accrual or the interest rate, and then to capture the market movement, one can add government securities also in it, which are for the longer tenure.
Okay. So it's a mix of tenure.
It's a mixture of tenure, but the overall maturity of the fund remains 3 years. Now that is up to a fund manager that how they keep it up to 3 years.
Sure.
They can have a corporate bonds of 3 year, or they can have corporate bond of 2 year and some of the GSEC also.
Okay. What about the interest rate fluctuation that you might see? I mean, from a mutual fund manager's point of view, how do they control the volatility in their portfolio, interest rate volatility?
So that is why the fund managers are there.
Exactly.
That they foresee that when you say that it's a short-term product, the allowance for a fund manager to reduce the duration is also up to 1 year. Agar wo 3 year product is also there. So if a fund manager thinks that the interest rates are going to go very high from
like
here,
for example, just give the current scenario. The interest rates are at a high right now. We are looking at a cut, coming up soon. US space, we have seen the cuts have already started now. So now if someone wants to park in maybe a short duration fund, and then we will see cuts in a couple of months coming up, what will be the interest rate fluctuation here then?
So as a fund manager, what is a loss for the market is an opportunity for me, right? So I will see that if 2 months down the line, if I'm seeing interest rate cuts coming in, then I will invest at these interest rate to lock in the higher interest rate.
Okay.
So when the eventually rate cut cycle takes place, I have locked in a yield at a higher yield, and that yield will go down. So let's say that I have locked in at 7%, there is a cut of 25 basis points, that yield has gone to 685. That means that I have had a profit of 15 basis points.
Right.
So as a fund manager, your job is not to be in the current market, but to looking forward. So I will not be bothered by what is happening right now, but what my view is happening going forward. So therefore, if I'm seeing that the interest rates are going to go higher from here, then I will reduce on my duration. But if the interest rates are to go down from here, I will take the opportunity and invest right now.
Okay. So for an investor, then it becomes very important to stay invested for the entire tenure and not remove the money in between. to take the advantage of interest rate fluctuations?
Right. So if you're selecting a category and if you're saying that you are selecting a 3-year product, best benefit will be if you stay invested through the tenure. But let's say that investor needs that money, that money is available. It is not that it is not available. And the beauty of the short duration is because it is shorter, the impact of the interest rate is not very high. That happens on the longer end of the products, which are like 7 years or 10 years, where the impact is much more higher. But because this is a short duration category, the impact will be lower. So your corpus might not will not get affected, but you know there will be M2M loss or gain which you might have got would be fluctuating. So if a return of like let's say you were getting of a 10%, you will get a 7% what your interest rate is.
Sure. So from an investor's point of view, in what scenario should we be considering short-term duration funds?
An investor who is looking investment for interim expenses is something that they should be looking at short duration funds. They know that they don't need money immediately, but maybe like after 2 years or 3 years to go through their interim expenses is something that they should consider short duration funds. And if an investor is looking at extreme short that he knows that I need it in 6 months or 1 year, then they should go for money market funds that the volatility is minimum over there and they can still be in the market and reap the benefit of it.
I can do a sweep FD to save my money. So what is the difference between a sweep FD and a short-term duration fund?
Short-term duration fund, again, you're like any other mutual fund, the liquidity is very easy. And if you are saying that on an FD, there would be some restriction as to when you can withdraw or the timeline which is given. For a mutual fund, even if you go for a 3-year product, you can withdraw it in 1 week also, 1 month also. That is up to you as an investor. Second is, if you are investing for a longer period of time, the taxation benefit is there. You would not be taxed every year versus what FD you will be taxed every year. So your accrual, the power of compounding comes in when you are investing for more than 1 year when you are investing in a mutual fund versus FD.
All right, I think that will be all for today. Thank you so much for being on the show. And we hope that our viewers and women viewers especially have understood what a short-term duration fund. Thank you so much for watching. Goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. If you like this video, then like, share and subscribe to ET Now.